Before we begin the program, here's a few notes. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. TechGirl Financial and Cambridge Investment Research, Inc. are not affiliated companies. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Fixed income investments are subject to various risks, including changes in interest rates, credit quality, inflation risk, market valuations, prepayments, corporate events, tax ramifications, and other factors.
What will you do when your money works for you? Welcome to the Tech Girl Financial Podcast with your hosts, Victor and Kim Gaxiola. From the home office in California, here is Victor and Kim.
Like a sunset or a pretty view, okay? There are occasions, and one of the benefits of working with you, Kim, is that occasionally you get really excited about something that's happening in the financial markets or in the economy. And I think starting last year, you started getting really excited about the changes that we were seeing in the fixed income space. And so today's podcast is really focused on that. And a lot of the material is based on a webinar that we did earlier this year. And so I wanted us to at least do a little bit of a conversation about, what was the enthusiasm? I saw that sparkle in your eye.
Oh, yes, because I've always liked bonds, really.
Okay.
And I think a lot of it has to do with a certain certainty of the bond market as compared to the stock market. Mm-hmm. There are so many different variables that go into the stock market, and I think that the bond market is a little more black and white. Okay. Well, just to back up a little bit, I think just from the standpoint of clarification and thinking about Investing 101, if you've been listening to the podcast, this, of course, you would know this. But when you think about investing, there are a number of different asset classes. So let's start there. So one of the asset classes, which I think people are mostly familiar with, are equities. And equities typically are stocks, mutual funds, exchange traded funds. It can be basically things that are, you're looking for growth, you're looking for household names that want to own those. So most people, I think, are pretty familiar with equities. Then you have fixed income, which is more the lending side, the bond holding. It could be, municipal bonds. It can be treasuries, just things that are looking to derive more like interest or dividends, yes,
right,
and
on the fixed income side.
And so when you think about fixed income, you're thinking about predictability. Mm-hmm. You want to know that you're going to get a certain return, a percentage return based on what you're putting into that investment. Mm-hmm. And so there's been more predictability in bonds always, but predictability doesn't mean a high yield. And so one of the things that's been frustrating about the fixed income market ever since until last year has been that, the predictability was that you were not going to get much for your money.
Mm-hmm. Right.
And now all of a sudden, after the Fed came in 2022 and increased rates several times all the way into the middle of 2023, the highest amount of rate increases in such a short period of time has created the opportunity and the excitement that I have today to know that we can get a lot more yield out of bonds today than we could have in the past. And when you look at most bond fund returns over a 10-year average, you wouldn't want to be in them. Mm-hmm. 0, 1, 2% average annual per year is not something that anyone would get excited about. Now, one thing I think is funny is that most people have a tendency to invest based on performance in the past. Yet in our job, we're always looking at what's going to happen in the future. And so we don't pay as much attention to performance in the past, and we look more at what we think will happen in the future. And now that rates have been lifted so much, the interest on these bond funds is great. Depending on the fund that you're in, if it's short-term, long-term, midterm, or if it's high credit or low credit, we can get somewhere between 4 to 7% about. Mm-hmm. And that's exciting.
Yeah. So, and to finish off on the asset allocation, I mean, the other two categories briefly would be real estate for many, and then cash or money market. So those are the four. You've got equities, fixed income, cash, and real estate in the most simplistic terms. And then depending on, who the investor is or what their objectives are, what they're looking to do, it's really if you want to think of it as a pie chart, is the different slices of that pie as to how much equity you have versus fixed income versus cash and real estate. And so a more conservative investor, someone who's looking to preserve that nest egg or preserve their holdings, are likely to have higher percentages or a larger slice of pie in the cash and fixed income. And someone who's a little bit more aggressive or looking to get a better return, their slice of pie is likely to be much larger on the equity side than it is in cash, fixed income, or real estate. So that's part of what we do is when we meet with people, it's really trying to understand exactly what their objective is for investing, the composition of their portfolio, then helping them reach a determination of what allocation and how big those slices of pie are going to be.
Right. And naturally, with our high insight into, looking at what's going to happen in the future, we may tweak those allocations based on where we see the economy going in the future. And so that's what I think is really exciting. I also think, it's easy for people to have discredited bonds and fixed income because they haven't acted the way they were supposed to in the last couple recessions. And what I would mean by that is just typically when stock markets have a bad time and go through a recessionary period where they're losing value, a lot of people will flock to bonds. Traditionally, people would flock to bonds because they're more secure and more predictable. Well, in the past couple of times that the market has pulled back quite a bit, people have gotten out of bonds too. And so we haven't had that traditional, opportunity or performance that would mean when the stock market goes down, the bond market goes up. Just hasn't happened. I haven't seen it in the last 10 years. And there's been a lot of pullbacks in the market. And so I think a lot of people have given up hope on bonds. And just when you give up hope is when you should get more interested in them, because I can explain or I can understand why bonds didn't rally in the last few times, because we have been in a 10-year period where the interest rates were close to zero. So there was really not much you could do in the bond market anyways.
Right. Yeah.
And today it's a whole different situation.
Yeah. So it's moving. Is it reverting more to a traditional, like we think about what you're talking about as the correlation that exists between, let's say, the equities and fixed incomes or bond, almost like a seesaw. So traditionally, if the stock market was doing well, the bond market wasn't as attractive, and vice versa. If the bond market was looking attractive, the equity markets were looking very attractive. And so you would find ourselves in kind of reverting more back to that traditional push-pull.
Yeah. And the logic behind that push-pull is the fact that when the market slows down, the economy is typically in a recession. And during a recession, the Fed will try to loosen things up by lowering interest rates. And in the bond market, again, this goes back to another push-pull situation, is that when interest rates go down, the price of the existing bonds go up. Likewise, in 2022, yields started to go up in bonds because the Fed was raising interest rates over and over and over, and the price of bonds went down. And so there's an inverse relationship. We talked a lot about that and how it impacts fixed income pricing in our webinar that we did. So if you want more detail about that, go to the webinar. But what it indicates to me right now is because interest rates have gone up so much in the past year and a half, we have room to pull that back down when we hit a recession and when the Fed says it's time to lower rates. And so that's what everybody is, on pins and needles, I guess, right now, thinking, paying a lot of attention to the Fed and saying, when are they going to start to lower rates? People are already feeling tight at home economically with their budgets. And so we're feeling like we need a little looser monetary situation. However, the Fed is based on data, and the data is very muddy. It's mixed. It's all showing yellow lights.
Yeah. Right.
And so we don't know what's going to happen. I don't think there's enough pain for them to pull the trigger yet.
Yeah, I mean, and we've been somewhat in this same holding pattern now for quite some time, in them maintaining rates as they are. And I think they're just waiting to see some sort of catalyst that's going to make them make a decision, or at least forecast the fact that the cuts might be coming. And I think that the markets will react to that, both on the fixed income side and on the equity side. But it did create an exciting opportunity, I think, at the tail end of last year, as we started seeing these shifts that were taking place where the bond market or the fixed income areas were looking attractive again. Traditionally, a lot of those fixed income assets have less volatility. They are a little bit more on the conservative side. And so I think that a lot of the enthusiasm that was being built up is that on a risk-adjusted basis, and this was the conversations we were having with people, on a risk-adjusted basis, the bond market was presenting scenarios whereby you might be getting equity-level returns, but without the same comparable risk that you might see in the equity side.
Yeah, we're still waiting for that to happen.
Yeah.
On our webinar, we said, maybe it'll happen in 12 to 18 months. I still feel like that's the case. Maybe we're closer to 12 months just because we're 6 months out from the last time we said that webinar. And so we're waiting. But in the meantime, if we are waiting for, the Fed to start lowering rates, because what that will do to the bond market and the price of our holdings going up. In the meantime, it's not a bad place to be when there's so much uncertainty in the market and the stock market has peaked. What a great place to be is in bond funds where, they're offering yields right now, depending on the fund, of course, but you could see something between 4 and maybe 7%. So we're not in a bad place to be right now, is to wait and see, have some money in these funds that are giving us yield. I want to talk about CDs because I know I heard a lot about clients putting their money in CDs. It's very exciting right now because maybe you can get 4%.
I never thought I'd hear you say the word exciting and CDs in the same sentence.
I know it's not exciting. And I will caution those who are using those CDs as their holding zone, that as it's been slow, and like you can look at major bank names and I still don't think they're offering great CD rates, but then you go to smaller banks and online banks and you get higher yields. Let me tell you, when rates drop, the banks will drop those CD rates pretty quickly. It'll be the first thing to drop. So I caution people when they look at CDs, those CDs are going to lock them in, and it's not forever rates. And they will drop probably pretty quickly when things change. So just something to keep an eye on and understand. I would say better things out there really are, and it depends on your level of comfort and risk, but I would look more at short-term bond funds and very conservative bond funds, which can give you CD-like returns, but you're not necessarily having to hold on to them for as long and have the opportunity for price appreciation when rates drop.
To say nothing of liquidity as well.
Yeah,
right?
absolutely. Yeah. So some other things that we want to speak to right now is, the yields. We were talking a little bit about the difference in yields, and you can get short-term bonds are averaging, at this point in time around 4%. What's interesting, though, is that all of the other categories, from U.S. Treasury bonds to global bonds to leveraged loans, multi-sector, corporate, and even high yield, the difference between what you can get from the U.S. Treasury bonds and a high yield bond is less than 1%. So what that tells me is that the credit spreads are very tight right now and very interesting. We don't think that this is going to be a long-term situation, and that's why we are more worried about where the economy is and if we are going into a recession. So that's just something to, kind of keep your eye on right now. It's what we're keeping our eye on. We thought we were going to be a lot more active managers this year in our bond funds, but we are still on a wait and see approach as well, because at this point, with yellow lights everywhere, it's not warranting a change quite yet. And so it's better off to be in safer products, I think, when you can get the same kind of return.
Yeah. So I think we're speaking a little bit about, peeling that onion. If the first cut was going back to the asset allocation conversation about the difference between equities, fixed income, cash, and real estate, now we're doing a little bit of a deeper dive on the fixed income space, that in any one of those categories, there's a number of different investments that fall under that banner, and that you have variety that you can choose from. So, going back to the yield, corporate versus treasuries, CDs, municipal bonds, bond funds. There's so many different facets within that category.
Yeah. And, another thing that I think is a big concern for people when this is a risk factor when we're investing in fixed income is, one, when will the U.S. debt be an issue? And two, if we're talking about municipal bonds, we have a large concentration of clients here in California, and all the media is talking about what a bad shape California is. But then, I do the due diligence and I talk to the analysts in those different markets that are looking at corporate bonds or municipal bonds, California more specifically, or even the U.S. government. And when it comes to California, they have very, very high reserves. And this still stems back to all of the free-flowing money that came out of the pandemic. And so those are the things to think about. I think what most of America, the United States, is worried about, though, is the U.S. debt talk. When will it be an issue? They are having to pay a lot higher rates, and they, meaning the U.S. government, is having to pay a lot higher rates to borrow money. And that is becoming a bigger chunk of the revenue sources that they get from us taxpayers. And so it is something to be very concerned about. Something that's interesting to note, though, is if you look at the average of how much of the GDP goes to pay debt, back in 1990, when rates were more similar to where they are right now, that was about 3% of the GDP revenue that was going towards debt payments. And when rates were really low in the past 10 years, that number was more like 1.5% of GDP. So even though it feels really uncomfortable that rates have gone up so much and the U.S. government is having to pay a lot higher price for the debt that they're issuing, it's back to more normal levels, which is right around that 3, predicting up to 2030, 4% of the overall GDP. So when you look at it in that way, is this the biggest issue we have? No, I think there are bigger issues.
Yeah, I think it speaks a little bit to that recency bias, from the standpoint that we are more likely to be thinking about this or gauging this against the most, in this case, the last 2-3 years versus what it might traditionally be on a, longer term scale.
Another area that is something we want to look at when it comes to bonds, because when we're talking about bonds, we're talking about the predictability of, one, that you get paid the interest, the stated interest rate, and two, that at the end of the term, the company or the government pays back the original principal that they borrowed. And so something that is a little worrisome at this point in time is that we are seeing delinquency rates rising. And the delinquency is not paying the interest, agencies or what have you, or people, whatever type of loan they are, those rates are rising. And this is more on the consumer balance sheet. And so if you look at credit card holders, you look at auto loans, you look at mortgages, HELOCs, all of those are showing that the delinquency rates are going up. And so that tells me, again, that the consumer is very tight. This can translate into, corporate fundamentals too, just because if consumers are tight, they're not spending that money. The only area that is doing well when it comes to delinquency rates, interestingly enough, is student loans. But I don't know. I haven't seen the detail behind that all. Yeah. But I would say that maybe that has something to do with the whole idea that the government is trying to help them as much as possible and help them pay it off and give them money for that.
Yeah, I mean, my concern is really on the credit card side, just because for the most part, when you look at delinquencies on a mortgage, delinquencies on an auto, there's still an asset that's held even in that delinquency. So worst case scenario, you sell the car, you sell the house, but on the credit card, it's just, digging a deeper hole. So a little scary there. And it may explain as to why, even though indicators, as we discussed in the last podcast, there'd be indicators in saying that we are moving possibly into recession and a slowdown, and yet people are still at restaurants, people are still taking vacations, traveling and such. It could be because of those credit cards that they're using. So borrowing, for future income as opposed to the income they're bringing in now. Yeah.
So to wrap it all up in the fixed income bond market, I would say there's a lot of excitement by me.
By Kim.
Over the predictability and the consistency of, a fixed rate of interest that you can get from bonds. And going into a period of time where there is a lot to question. And what I mean by that is this is 2024, which is an election year. And so not only do we have all these uncertain economic numbers out there, but we also have a lot of uncertainty and fear and a lot of talking heads out there, creating a lot of confusion for people. And so anything is unpredictable in an election year. And the last couple have been definitely very unpredictable. And so fasten your seatbelts and hold on tight, and don't do anything irrational on a whim, because there's going to be a lot of fear, uncertainty, and a doubt put in your mind from the media.
Yes, absolutely. And as Kim had mentioned, this is kind of a high-level executive summary conversation about a webinar where we did do a much deeper dive on this. If you're interested, we will include a link to the webinar so you can see the replay on the show notes of the podcast. But if you go to our website at techrofinancial.com, under Insights, you'll see our blog and webinars, and that's where you'll find a recording of the fixed income webinar that we did earlier this year that goes into a little bit more detail. So if you want to geek out like him, that'd be the place to go. Another thing is, when we start talking about fixed income, and a lot of that obviously is related to interest rates, we've been talking a lot about the housing market. I mean, that's been something that's been discussed quite a bit in the last year. So we're excited to announce that we are going to have a returning guest to the podcast. So Janine Towner-Chernoff, who's with Guild Mortgage, is going to come back. And she specifically is going to focus on something that is getting a lot more traction, especially for people who own homes that have equity in their homes and are looking to make a change, in talking about equity conversion loans, also AKA reverse mortgage. And there's a lot of interest in that. Amazing information, certainly demystified it for me. So we're excited that she's going to be on the podcast to share a little bit more about her insights on the housing market.
Yeah, so home equity conversion mortgages are for senior citizens. As a reminder, it's not for everyone. Mm-hmm. And so if you're listening to this podcast and you are in that sandwich generation like ourselves, mm-hmm. where you are thinking about the financial stability of your parents as they age, definitely listen into this. This could be one of the options available. Or if you are a senior citizen and listening to us and thinking things are really tight with inflation, I encourage you to hop on the call or hop on the podcast.
Yeah, listen to the podcast. And of course, we'll provide contact information and ways for you to ask questions or contact us. Obviously, if you have any questions or concerns or inquiries, I should say. So as always, when we create these podcasts, we sit down and we start writing a list of themes and areas, subjects that we think would be of interest to individuals. But as always, I like to say we're open to suggestions on any specific area that you'd like us to address or a special guest to have on the program. I'd love to hear about it. Just provide that feedback directly through the show notes on the Contact Us button.
And as I briefly touched upon uncertainty with a presidential election, and we are in the summer months, I just want to explain a little bit more to remember not to get divisive. And it really doesn't matter who wins. From a market perspective, it's more about certainty of what to expect in the next 4 years versus uncertainty in the time period we are in, because we really don't know who's going to win or lose. And so just as markets hate uncertainty, we all fear as Americans uncertainty as well. And so, there's a lot of studies out there that show it really doesn't matter who the administration is for the market or for the economy. It really just matters that we have a little bit more certainty. So don't get caught up in all the drama.
That's a good reminder. I mean, and you're right. I mean, the truth is that it's really more the consumer's decisions, what's happening at a corporate level, that really drives, the economy, and it drives the direction, unless the administration that's in the White House or who's in Congress. So we'll see where we go with that. Obviously, there are other parts of the country that I know are getting a whole lot more political rhetoric. We're here in California. We don't hear much.
Adapt and thrive. I'm just going to put it that way. Adapt and thrive. And that's what we do every 4 years.
That's right. That's right. So on that note, we just want to thank you again for listening to the program. Like I said, if you have questions or inquiries, please reach out to us. We certainly appreciate all of you who do listen and provide that feedback. It's valuable to us. And we look forward to having, another podcast and welcoming some amazing guests to the show. So as always, like to end with our tagline, which is to say, what will you do
when your money works for you?
See you soon. Bye.
Bye.
If you have questions, comments, or suggestions for future shows, please send an email to victor@techgirlfinancial.com or join the conversation on Twitter using the hashtag AskTGF. We also encourage you to follow us on the Tech Girl Financial page on Facebook and connect with us on LinkedIn.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. TechGirl Financial and Cambridge Investment Research Inc. are not affiliated companies. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Fixed income investments are subject to various risks, including changes in interest rates, credit quality, inflation risk, market valuations, prepayments, corporate events, tax ramifications, and other factors.